Hey everyone, welcome back to Corporate Decoder. Today we're diving into the world of BioAffinity technologies and their recent filing. A bit like stepping into a doctor's office, but instead of stethoscopes, we have spreadsheets and legal jargon, which might seem less thrilling, but trust me, there are stories to uncover. This filing is essentially their attempt to raise more money by selling stock and something called warrants, which we'll unpack, but is it a good deal for investors or a sign of deeper struggles? Let's find out. First off, this is a registration statement, meaning BioAffinity wants to sell new securities, basically shares of their stock, and these things called warrants. They're hoping to sell a lot of them. So BioAffinity calls themselves an emerging growth company and a smaller reporting company. These mean they get to skip some of the usual, more complicated reporting rules that bigger companies have to follow. Think of it as a new business discount. They'll get to keep using these shortcuts for a while as long as they don't make over $1 billion in revenue, issue over $1 billion in debt, or become a really big company. Now, let's get to the heart of it, this thing called the offering. They want to sell over 7 million shares of their common stock. But also to certain investors, they're offering pre-funded warrants. These are basically a cheaper way to buy the stock later at a super low price, only about a penny a share, but there's a catch. They can only be used by investors who would end up owning too much of the company otherwise. Alongside the stock, they're also offering April 2025 warrants. Each share of stock comes with a warrant to buy 1.5 more shares, so it is a bit complicated. These warrants have some interesting terms. The warrant includes anti-dilution provisions which are designed to protect the investor from the value of their warrants going down, but could end up being bad for other stock owners. Of course, no financial document would be complete without a hefty risk factors section, the place where companies list all the things that could go wrong. Reading this is a bit like watching a disaster movie. One of the big ones, our business plan relies upon our ability to obtain additional sources of capital and financing. In simple terms, they need more money to make their plans work. If they can't get it, things could get tough. Also, since the company is a non-accelerated file and a smaller reporting company, it has a lower burden on how it reports to the SEC. This means less frequent and detailed financial disclosures. The company might not be doing anything wrong at all, but smaller reporting requirements can create an environment where problems can be hidden, where problems can be hidden. The company patents can be reduced or eliminated for non-compliance with governmental requirements. In other words, small admin errors may cost them patent protection. Now it's time for financials, the section where we separate the hype from the reality. Okay, this is a big number. It means they've lost a total of $53.6 million over the course of their existence. And $1 million in cash is not a lot for a company like this. In the past year alone, they spent $1 million to keep the business running and lost $9 million overall. That's a lot of money going out the door. Even their accounting firm is waving a red flag. They included a warning in their report, saying that the company's financial situation raises substantial doubt about its ability to continue as a going concern. That's accounting speak for this company might not be around much longer. Let's take a look at where they make money. Their total revenue for the year was about $9.4 million the year before. That's a big jump. However, we need to see the details of the expenses to see how this number compares. Operating expenses went way up. Selling, general and administrative costs nearly hit $10 million. It makes sense that sales expense is up because of the big push to market Sipathulun. The exercise price of these warrants can be reset, which sounds good for warrant holders, but it means big dilution for regular stockholders. Dilution in accounting is when you print more of the existing shares, which results in current stakeholders owning less of the company due to more shares being outstanding. So these warrants might not end up being a great deal for shareholders in the long term. What's the story here? BioAffinity is trying to turn promising technology into a profitable business, but they are burning through cash very quickly. As usual, a company's management has broad control on how it spends the money it gets from issuing new stock. There's no guarantee that it will be spent wisely and generate returns. This could really throw a wrench in their plans. If they can't get this approval, the warrants are worthless and they miss out on a big chunk of potential funding. Small point, the company dictates which courts to use in case of issues. This might seem innocuous, but is used to make lawsuit more difficult. Also, the board can issue preferred stock, which can change the dynamics for the common stock. This means that a subset of stakeholders might get priority and control over the other shareholders, which are usually normal people. Finally, the placement agent facilitating the deal only needs to give its reasonable best efforts. That doesn't sound very assuring. Overall, BioAffinity is at a crossroads. Their technology has potential, but their financial situation is precarious. They need to either cut costs, find a major partner, or hope that this offering and other future ones can keep them afloat. The biggest risk? They don't have a clear path to profitability and are burning through a lot of cash. There are also major dependencies on the results of tests, studies, etc. They are selling the dream, but dreams are hard to monetize. There's also a lot of language about warrants, which is often used to obfuscate or make things more complicated than they are. The biggest opportunity? Their lung cancer diagnostic could become a game changer, but only if they can get it through regulatory hurdles and convince doctors to use it. I'd recommend staying on the sidelines for now. There are too many ifs and not enough certainty. It might become a good opportunity after de-risking, but for now, this is a wait and see stock. Thanks for watching. If you found this helpful, please like, subscribe, and let me know in the comments what SEC filings you want me to decode next.